Surging Treasury yields is probably one of the most overlooked issues today, and they pose a significant risk, specifically to manufacturing, for more than one reason. We're referring to very strong mortgage rates we've seen lately, but not only mortgage rates, also U.S. Treasuries. They've been very much on the move to the upside. That in part is due to the expectation the Federal Reserve is not going to cut rates as aggressively as we once thought. We can see overall we still have very much an inverted bond market. We want to specifically talk about the 10-year US Treasury for a very specific reason. Now, we can see here, especially on a monthly basis, it's the midterm maturities, the 2-year, the 5-year, and the 10-year. These yields have been up quite dramatically also on a weekly basis and even a daily basis. But it's the middle part of the maturity scale that's really been moving higher. Now, what we want to talk about, first of all, is the mortgage spread. The mortgage spread is the average 30-year mortgage that we see advertised minus the 10-year US Treasury. You see, what happens is the mortgage rates obviously move in line with the Treasury market to some extent. However, the banks will build in a little bit of buffer. The difference between the average 30-year mortgage and the 10-year US Treasury is a risk. It's how much risk the banks are building in. They're actually not seeing that much risk right now. Now, the white line over here shows us the mortgage spread. This is over the past month and a half or so. In blue, that's a 30-year mortgage. In red, that's a 10-year US Treasury. First off, we see mortgage spreads are actually declining. These mortgage spreads decline. The difference between the 30-year mortgage and the 10-year US Treasury, that again shows us how much risk the banks see in the marketplace, that's actually going down. The banks actually, at least on the surface, according to the mortgage spread, are quite optimistic. But at the same time, we're seeing 10-year US Treasury yields move higher and higher. So when we see these 30-year mortgages are quite strong, don't blame the banks so much and don't think that it's necessarily because the market's on shaky footing. It's rather the majority of this move higher is just the pure Treasury market. Those yields have been soaring. Now, the mortgage spread, we take a look at historically where we have a 228 spread. That again, very simply, you take the advertised 30-year average mortgage, subtract the 10-year US Treasury, it's 2.28% difference. We actually haven't seen a mortgage spread this low since April of 22. So now again, when the spread goes down, it shows us the banks are more optimistic. So in other words, the banks, at least in terms of the mortgage market, they're now in more of an optimistic, kind of stance than they've been since mid 22. So that's a good thing. The business sectors are specifically affected by high interest rates. Well, it's pretty obvious. Manufacturing, construction, finance, real estate, consumer discretionary. All of these are affected by interest rates. As interest rates rise, obviously it costs more money to borrow money for large construction manufacturing projects, but even smaller purchases, consumer discretionary, think of the holiday shopping season coming up. Those higher interest rates do tend to weigh on the economy. But higher rates have a secondary effect that we haven't even spoken about yet. We're talking about the dollar. In this case, this is dollar against the Swiss franc. It has been on the tear. It's also been moving up. The dollar usually moves in the same line, in the same direction as yields on the Treasury market. The dollar's been very strong for the past month. A strong US dollar makes our exports more expensive. It simply requires more euros or more British pounds to buy the same product that is created in dollars. We would ask you, which sector from the ones we've mentioned do you think has the most exposure to foreign exchange risk? Manufacturing, construction, finance, real estate, consumer discretionary. Well, by far it'd be manufacturing. The goods that we manufacture here that are priced in dollars now, because the dollar's so strong, require more euros or more British pounds to buy those goods. So the manufacturing sector in particular faces really the perfect storm. We have higher interest rates, And that tends to weigh on the production locally, domestically, as well as the sales locally, domestically. What we produce here, well, higher interest rates make it more difficult, more costly. Think also of durable goods, those big ticket items like washing machines and appliances. Higher interest rates tend to make those products more expensive. But the higher interest rates and the strong dollar also makes our exports more expensive to international sales. Now, we've spoken about this before, actually quite recently, specifically in the manufacturing sector. Take a look at the Empire State Manufacturing Index. Prices received, that's been down lately. Prices paid, that's been up. Well, they've actually both been up, but the prices paid is up a lot more. Think of the exports, the prices received. The international buyers are not able to afford the same amount of U.S. goods. So the prices received, the amount of money our manufacturers receive for the goods they produce, not domestically, but from foreign purchases, that is not as strong. The prices paid, well, that's higher because if the manufacturers have to borrow money on a credit line and that credit line is attached to interest rates, that makes those prices paid higher. So this is a dynamic that manufacturing has been plagued with for the past year or so. And this resurgence in interest rates and a resurgence in the US dollar really is not helping manufacturing very much at all. We can also see this play out in the Philly Fed Manufacturing Index. In addition, we can see over here, prices paid, it's a lot more significant than prices received. And this, again, is not good for the manufacturing sector. So we have durable good numbers coming up and a few other pretty relevant pieces of information on the economic calendar, which should shed some light on this issue. But for the time being, as long as we have the anticipation that the economy is on somewhat of a recovery, that the Federal Reserve is not expected to cut rates, aggressively quite yet, we'll probably continue to expect higher interest rates and also a strong dollar. And this should not maybe play so well for the manufacturing index. We hope this has been helpful. We hope to see you back soon.